Hi, everyone. Thank you for joining us today. I'd like to welcome you to this webinar discussion on public facilities corporations. I'm Esme Thoman, and this is my colleague, Carley Butler, and we will be hosting the webinar.
Good afternoon. Esme and I are part of Butler Snow's Government Affairs and Regulatory Group in Austin, Texas. We provide consulting and real estate advisory services to multifamily developers and help them navigate public incentives. And today we'll be discussing the PFC tool.
Okay, let's get started. Okay, what is a public facility corporation? PFC is a public-private partnership tool that is used by local governments to create workforce housing and promote economic development. It is governed by Chapter 303 of the Texas Local Government Code. It's a nonprofit corporation, and it must be formed by a sponsoring entity. So those entities could include like a city or a county, a community college district, hospital district, or other taxing authorities and special districts. As you can see on this slide, local governments create PFCs and thereby provide a property tax exemption in return for the development of multifamily housing offered for moderate incomes. A PFC, some of the characteristics of a PFC include a few things. The main one being that a PFC, a property owned by a PFC is exempt from property taxes. A PFC must be formed for public purposes, and a PFC can own and finance property and issue tax-exempt bonds. Okay, so to really kick off the PFC discussion, we have to address the 2015 legislative changes to Chapter 303 of the Texas Local Government Code. The 2015 legislative action amended the Local Government Code and exempted PFC-issued leasehold interest from the tax treatment of leasehold interest under Section 25.07A. And what that means is typically when a property is leased for more than 1 year, the lessee would be considered the owner and taxed as such by an appraisal district. So for example, prior to the 2015 changes to this chapter, if a for-profit development partnership entered into a lease for more than 1 year with a nonprofit, the for-profit developer, so the lessee, would be considered the taxing entity and taxed as such. After the 2015 changes, that was no longer the case. So now the change allowed for the tax exemption to be kept by the for-profit entity despite the fact that there was a long-term lease. 2015 was really an inflection point in how Chapter 303 was utilized by developers. So as a result, when a public facility corporation, for example, one that was created by a housing authority or a city or a county, leases land and land improvements to a for-profit development entity, that leasehold interest is now taxed in the name of the public facility corporation and receives 100% property tax exemption. So in summary, 2015 was a really big year. It changed Chapter 303 tremendously, and it allowed for property owned by PFC to be leased under a long-term lease, so for more than 1 year, to a for-profit development partnership where the lessee or the for-profit partnership received 100% tax exemption, and the local government only served as the minor limited partner. So moving on to the next slide, you can see how a PFC structure works. So here you have with the developer acquires control of the land, that the land ownership is then transferred to a public facility corporation. The PFC leases that land in the to-be-built apartment complex to a newly formed development partnership for 75 to 99 years through a ground lease. The development partnership then builds and rents apartments on the land, and the partnership is exempt from paying any property taxes on the land or the apartments in exchange for developing multifamily units offered to moderate incomes.
Okay, thank you, Esme. That brings us to the next slide, which is PFC media attention. From the 2015 change and into 2023, this tool was utilized throughout the state. It drew media attention and legislative scrutiny. In 2019, when a University of Texas report by Heather Way shed light on the perceived misuse of this tool, especially as it relates to affordable housing. Legislation was proposed in 2021 and really gained momentum in our last session this year. There were over a dozen bills filed that impacted Chapter 303 of the Local Government Code. Some of the legislative proposals included reforms and others called for an outright repeal of the chapter. In the most recent legislative session, J.C. Jaton filed HB 2071. There was concern that the public benefit didn't justify a property tax exemption. Two of the PFC pressure points with legislators that were highlighted when PFCs were discussed included: one, jurisdictional issues where PFCs were going outside of their boundaries, and the lack of oversight when a PFC was involved with the acquisition of an older property where the rents were already below 80% AMI and no real affordability was created in exchange for the property tax abatement. The main goal from the industry participants was really to protect the PFC tool and allow for local flexibility. The industry wanted to preserve the tool and clean it up is what they wanted to accomplish with this legislation. So let's look at the changes in 2071 on the next slide. HB 2071 was really the consensus bill and addressed the following concerns. It improved transparency, added more local control, included strict compliance and reporting, affordability and best practices were addressed, as well as acquisition requirements. There was tremendous input from stakeholders regarding this legislation. There were numerous concessions made on all sides for this legislation to make it across the finish line. It was tough. It's important to note the legislative changes made to Chapter 303 and Chapter 392 of the Local Government Code do not apply to PFC-owned multifamily residential developments that, one, have at least 20% of their residential units reserved for public housing, and two, participate in the rental assistance demonstration program. Three, receive financial assistance from a tax exempt bond or receive financial assistance from the LIHTC program. Prior to this bill, a sponsoring entity was not subject to jurisdictional boundaries. Now there are jurisdictional requirements. A development has to be located within the sponsor's district, and there must be notice sent to all taxing units 30 days prior to any PFC board action. The tax exemption was also capped at 60 years. With a renewal option. The PFC tool is very effective. PFCs were already incorporating a lot of these practices before the changes of HB 2071, and this just really formalized them.
Okay, thank you. So as Carley covered, House Bill 2071 made several changes to Chapter 303 of the Local Government Code. One of the most impactful were the affordability requirements that are now required of public facilities corporations. So as you can see on the table, that prior to House Bill 2071, the only affordability requirement for PFCs was that 50% of the units be at 80% of adjusted median income. There were no rent restrictions, no adjustments for family size, no housing voucher program requirement. That one income restriction, the 50% of units at 80% AMI, was the only standard. Now, moving on to the third column, after the changes to the statute, income restrictions now require 40% of the units at 80% AMI, 10% of the units at 60% of AMI. Rent restrictions for a PFC have to include 30% of 60% AMI and 30% of 80% AMI. There is an adjustment for family size required by HUD. Restricted units must be distributed among bedroom types. There can be no income source discrimination for housing choice vouchers. There are certain tenant protections that are included. There can be no retaliation against a tenant if they choose to be part of a tenant organization. And now the land use agreement must document the affordability for at least 10 years. So a lot of PFCs across the state already were incorporating some of these changes into the best practices, especially the affordability requirement and the land use agreements. But the biggest change that we've seen based on the feedback we've received from the developers we work with is that, you know, a lot of these PFC deals have started to move away from the larger urban high construction cost developments that included like wraparound parking garages, et cetera. And they're moving towards, and the reason being is because of the affordability requirements that we just reviewed here on the slide, and they're moving towards a more a 2 to 3 story structured garden style, less density in suburban areas. That's similar to what you see in a LIHTC development. Those are just some of the changes and the responses that we've seen in the few months in response to the statute changes. It remains to be seen how those shifts, you know, what shifts will occur as we move on, you know, interpreting the changes to the statute. Okay, so moving on to local control. Let's see. Okay, so local control was also a hot topic that was discussed during the legislative session. Prior to House Bill HB 71, as you can see in this before column, there were no jurisdictional requirements. And what that means is that a development, really a PFC could have a development that was located anywhere in the state. And housing authorities did have to have a public hearing, but there was only an approval needed from the PFC board. The 100% tax exemption was typically between 75 and 99 years, or for as long as the PFC owned the land. So the statute changes updated a lot of these, most importantly, jurisdiction. So now all developments must be located within a sponsor's boundaries. That was a huge topic that garnered a lot of the media attention and why these reforms were even needed. So now all non-housing authority PFCs must be located within the sponsor's boundaries. A caveat to this is that housing authority PFCs through Chapter 392, boundaries can be extended to include the areas in which they operate, and those can be expanded by them entering into a cooperative agreement with another city or county housing authority. So moving down under the new statute, there are notice requirements. There must be notice to all taxing units given 30 days prior to a PFC board action. So there are really 2 PFC board actions. The first of which is the PFC board approving a term sheet, and that's a non-binding agreement. And then the notice requirement comes in when we're discussing the final PFC board action. 30 days must be given to local taxing authorities before that one. And then moving on, the new statute stipulated that elected officials must weigh in certain situations. So if the majority of the PFC board are not elected officials, then city and county officials need to weigh in. If most of the PFC board is made up of elected officials, this requirement obviously doesn't exist, although it's been common practice to see city and counties giving approval for these PFC deals, especially in light of the past, I would say, 12 to 24 months when the jurisdiction requirement wasn't in place. It's important to note that many of the housing authority boards are appointed positions. And so in that case, they're required to get the city and county approval. And how you distinguish between city or county, if the development is located in a city, you need city approval. If it's located within a county, you need county approval. And as a practical matter, this isn't super onerous on, you know, the PFC or the developer, but it does and can extend your timeline. So we recommend our clients, you know, bake that in because it will affect you when they close. This won't apply to everyone, but the property tax exemption does not include MUD taxes without a written agreement. And then lastly, the exemption term is now 60 years with an option for renewal. And that is in contrast to, and a departure from the 75 to 99 years that was previous. So it remains to be seen how underwriting will take this into account. From our perspective and what we've seen is that you see leases that include the 75 to 99 years still, with the understanding that at 60 years, there's an option for renewal, and that you would just have to go back to the PFC board and get approval for that. We don't know what the impact to underwriting really will be. I think it remains to be seen that, the impact there. And then based on some of the feedback we've received from developers and from other PFCs, 60 years is still acceptable. AMIs in Texas are fairly high, and the affordability component required by these changes or by this bill is tolerable. The general feeling in the industry is that many of these changes incorporated into this new statute were part of best practices anyway. This just formalized them, and these changes create consistency across the state, which we believe is a net positive.
Okay, thank you, Esme. Let's take up on the next slide, transparency. Before HB 2071, the only requirement was that housing authorities had to have a public hearing. Following this table, after HB 2071, there is an underwriting assessment to determine if the development would be feasible without participation of PFC. Some legislators felt like it was critical to prove the amount of tax abatement received was directly tied to the reduction in rents. This is a difficult calculation to do when dealing with pro forma numbers. For new construction, the report must be done showing the threshold a project would not be feasible but for the tax abatement through PFC involvement. Practically speaking, the but-for tests have been used as a best practice during underwriting. Now the real change is the requirement of these numbers and calculation be posted on a public website. These numbers are confirmed by a separate third-party evaluation. PFCs are using third parties to perform these assessments from organizations such as Novogradac, which I'm sure everyone is familiar with. The but-for test is unique and dependent on the development, whether it be new construction or rehab, is meant to demonstrate the public benefit for the community. There's a notice requirement to all taxing entities 30 days prior to PFC board action. Information must be published on a website showing compliance requirements and voucher participations. And PFCs are required to affirmatively market to voucher holders as well as notify public housing authorities. The new legislation increases the transparency required in disclosures and public information available. Now the information should be easily accessible to the public. Okay, we can go to compliance and reporting. As you can see on the slide, audit reports are now required to show the compliance with affordability metrics. The third-party audit report must review the difference in the market versus restricted rents. The third-party report is then submitted to TDHCA. Most PFCs were already conducting third-party audits. The change here is that the third-party reports are now sent to TDHCA. Best practices from PFCs across the state require third-party audits anyway, and it was typically a stipulation of many partnerships to begin with. Now TDHCA is required to review these third-party audits and report notice of any non-compliance. They must also report non-compliance to the appraisal districts and the PFCs. TDHCA is basically serving as a clearinghouse here for this information, but they do not have any enforcement capabilities that impact the tax abatement status. One little quirk that I would like to note in the legislation, I found it kind of funny, and it's definitely an overcorrection. A PFC must now rotate the audit firm every 3 years. This is going to complicate things because a PFC audit is very different than what you see in a traditional financial audit. The PFC affordability audit is trying to demonstrate the public benefit achieved. The statute's language does not provide guidance on exactly how or what this report should say or how it determines the public benefit. There will obviously be an incremental cost and is a bit redundant for multiple agencies to be reviewing and having oversight over these audits. I think we've seen overcorrection in this area. There is more work to be done here, especially how the audit requirement impacts historical PFC deals. And the industry feels like this compliance portion in the statute punishes the entire industry for the actions of a few, most notably the PSCs that were going out of their jurisdictional boundaries.
Okay, thank you, Carly. Moving on to acquisitions. So this one's a doozy. Acquisitions were heavily impacted by the changes to Chapter 303. I keep saying that, but I really do believe acquisitions are most punished. So conversion, so acquiring an existing property and converting it into a PFC were one of the main reasons that the statute was reformed to begin with. The acquisitions of older properties where the demographics were not changing, where there was naturally occurring affordable housing that already existed, and taking those properties off the tax rolls to no tangible public benefit was not the intention of the tool. And that is the reason that we see, and we probably needed some of these reforms to address the misuse of the tool. The new provisions are unlike, the new provisions probably mean that we'll see less conversions taking place because it's unlikely that, number one, someone can benefit the public benefit achieved, and number two, make the numbers work given the affordability requirements that we previously discussed. However, there are two scenarios for a PFC acquisition on an existing development to receive a property tax exemption. One where there is a renovation occurring, and one when there is no renovation occurring. Prior to House Bill, and this is the second column I'm referencing, but prior to House Bill 2071, conversions with and without renovations, the only requirement was that 50% of the units be at 80% of AMI. That was the only requirement. So now, given the changes to the statute for conversions with a renovation, this is what a PFC must meet. 40% of the units at 80% AMI, 10% of the units at 60% AMI, and 15% of the gross total cost must be spent on the renovation. So this 15% threshold is not clear in statute, but a conservative interpretation among those in the industry assume that it would mean that the threshold was based on a settlement statement for the acquisition of a property to set basis. For conversions with a renovation, the exemption length is 30 years. So moving on to conversions with no renovation taking place, the PFC requirements include 40% of units at 80% of AMI and 25% of units at 60% AMI. And for this scenario, underwriting must show a but-for analysis that shows the need for a PFC, in addition to showing that the reduced rents equal at least 60% of the anticipated tax savings. So in an example where you have a $500 per year tax obligation prior to a PFC conversion, a but-for analysis must demonstrate that at least 300 or 60% of that rent reduction, there is a rent reduction of that much, 300 per year, 60% on an annual basis. In addition to those threshold tests, conversions must obtain local approvals. If a development's located in the city, they must get city council approval, otherwise county commissioner approval, and a conversion without a renovation, the exemption term is 30 years. Let's see. These new provisions required are much more onerous on acquisitions, and removing existing property from the property tax rolls requires demonstrating the public benefit, which is just going to be hard to do. The PFC structure, certainly in light of the changes and the reforms, could be well suited for LIHTC developments coming up on year 15 and year 30, because in those situations, a PFC and LIHTC structure could easily demonstrate that, but for the PFC, that the community would lose the affordable units that the LIHTC development was already providing. So did I cover everything?
You covered a lot. Thank you for all of that, for all of that information. I do agree. We've mentioned throughout this that a lot of these best practices were already being put in place by developers that were participating in the PFC tool. I will say that we need to look for clarity to be given to certain things like what basis is used and the timing of the renovations going forward. I think we might see that pop up in future legislative sessions, and we'll definitely be monitoring that.
Okay, so moving on to it's towards the end, but it's one of the last slides. I'm going to briefly discuss this one. And I wanted to visit about the statutory property tax breaks available to affordable housing developments in Texas, the other ones that are in addition to the PFC or Chapter 303. As we've covered at length at this point, the PFC structure allows a leasehold interest by a private owner or a for-profit developer to remain tax exempt as long as they meet the requirements under Chapter 303. A similar arrangement is available under Chapter 392, which applies to housing authorities, and Chapter 394, which applies to housing finance corporations. In these arrangements, the public partner must be the general partner of the lessee, among other requirements. So what's attractive about that scenario is that under Chapters 392 and 394, there is an ability to obtain a property tax exemption without being subject to all of the requirements that we've just gone over under Chapter 303, as long as you obtain what is called equitable title. An equitable title is determined by having the public partner as the general partner of the lessee. So this gives the public partner, so the governmental entity, control rights to the property or clawbacks to gain control. I will mention that the housing finance corporations that we've spoken to are proceeding extra cautiously given the changes and reforms made to 303. They don't want those same changes being enforced on, Chapter 394. So they're proceeding very thoughtfully in keeping their HFC deals and their PFC deals completely separate. And you'll see that with a housing finance corporation deal, they typically target workforce housing or LIHTCs. I know I briefly discussed HFCs today, and the reason I did that is because we'll go into more detail on them in our follow-up webinar to this, but I did want to touch on that there are other programs available to obtain a property tax exemption. And I think that's it. That leads us to, I believe, our contact information slide. Thank you all very much for joining us today to discuss public facilities corporations. We really appreciate your time and your interest. I'd also like to mention that the Butler Snow team helps our clients navigate federal, state, and local incentives that are available to you and how to best take advantage of them. And if we can help you, we'd love to do that. If you have any questions or comments or want to visit about anything that we talked about here, feel free to reach out to us. Or if you're interested in, real estate consulting and advisory, our emails are included on this slide. And that's all I have for y'all today. And thank you for your time. And we look forward to the next one.